The rise of cryptocurrencies has spurred a rethinking of what a currency is, who regulates it, and what it means when a currency is no longer controlled by a national government. The dollar itself may be getting an overhaul, transformed into a digital currency that can travel instantly around the world, holding up against cryptocurrencies like Bitcoin or any other token. We are heading in a direction where the old battle lines between national currencies are being redrawn by an advance in cryptocurrencies. These privately issued currencies are fragmenting monetary systems, banking, and payments. The landscape calls to mind the money era of the mid-1800s, when a bunch of banks supplied their own notes, prompting the Federal Reserve to establish a national currency. With a no questions asked currency, the governments risk losing control over fiscal and monetary policies. What kind of disruption will the new currencies wreak? It is too early to say, and frankly, no one knows for sure. There are plenty of legitimate use cases for cryptos and applications built on blockchain networks, but the technology is so disruptive that it is triggering calls for a cascade of new regulations, and it is encouraging governments around the world to think about digitizing their own currencies, at least partly to remain relevant and maintain control over their economic interests. The Federal Reserve itself is expecting to weigh in with its own report in the coming days. The arrival of digital currencies may allow people and businesses to get around banks. If cryptocurrencies become a substitute for the dollar, that could create a separate money environment, one that would make monetary policies more difficult, if not impossible to implement. Cryptos and other tokens are not even close to denting the $19.4 trillion of US money supply or the 50% of international trade that is carried out in dollars. Vast markets of global commodities are priced in the dollar. But challenges to the dollar posed by blockchain technologies aren't so easy to dismiss. Bitcoin recently became legal tender in El Salvador, a controversial monetary shift in the country, but one that could pave way for other developing nations. Big money is at stake, especially for banks and other companies that charge hefty fees for moving your dollars around. North American banks and card networks earn huge sums for payments and credit card services, approximately $500 billion a year. That amounts to an estimated of 2% of US GDP, and much of it is in credit card fees. One of the biggest financial policy battles that is shaping up in Washington is over the digitizing of the dollar, turning it into a token that may be issued directly to the consumer by the central bank. A much anticipated report is expected soon from the Fed, outlining its perspective on a central bank digital currency. A digital dollar could take many forms. The basic idea is that central bank would issue a new digital instrument for transactions and deposits. Payments could settle in real time, and fees could fall sharply since the Fed does not have a profit incentive. That could be a huge win for the 6% of population that's unbanked and pays steep fees for check cashing. People sending money overseas could also pay a much lower fees for remittances, cutting out the middleman like Western Union and MoneyGram. Regulators are not sitting idly as digital currencies plant roots. Federal and state agencies are working on rules to keep tabs on the industry. Still, it will not be easy for regulators to tax or police the entire industry. Crypto brokerages outside the US handle much of the trading volume. Exchanges like Uniswap use protocols and smart contracts to process transactions, operating independently of any centralized entity like a bank or a brokerage firm. The dollar won't go down easily. It has deflected multiple threats since President Richard Nixon ended its peg to the dollar in 1971, turning it into a free-floating fiat currency. A period of inflation in the 1970s, the rise of Japanese yen in the 1980s, and the euro's ascent in the early 2000s all failed to knock it down. A common marketing case for Bitcoin, the largest cryptocurrency, is that it is digital gold with a fixed supply of 21 million tokens. By design, it cannot be increased, unlike fiat currencies that may be depreciated by governments for political or economic gains. Central banks have embarked on a money printing spree. The Fed's balance sheet has ballooned to $8.3 trillion from $1 trillion in 2008. Crypto backers argue that dollars' purchasing power will diminish due to inflation, while cryptos will hold more of their value. Yet for all the whining and the erosion of the purchasing power in the dollar, the economics is far more complex. Inflation has not proved deeply problematic in North America since the early 1980s. Before the COVID-19 pandemic, inflation was so low that policymakers worried about deflation. Rising labor costs and global supply chain disruptions pose near-term inflation threats, but their persistence is not assured. The forces that have kept a lid on inflation, including aging population in developed economies and productivity gains from technology, are not going away. History is also on the dollar side, in the sense that governments have never allowed a rival currency to take over their authority. The greater the success of currencies like Bitcoin, the more governments may try to kill it. For now at least, the dollar will live to fight another day.